Peng Shui clearly isn't at the forefront of China's economic boom. But like thousands of other backwaters across the country, it has big plans for the next 5 years as it seeks to boost incomes by at least 14% annually. The most meaningful economic decisions are made far away from Beijing, in places like here, Peng Shui, over 1,500 kilometres southwest of the capital. Few, if any, here are interested in cooling economic growth or slashing investment plans, as this is the only model they know that can provide jobs, spread more money around, and it's hoped keep their people content. And in this belief, the local authority plans to plough some $2 billion every year into investment in buildings and infrastructure.
The pace of our development is very fast, but we are very poor. We are backward, we are underdeveloped, we're coming from a very low starting point. That's why in our new 5-year plan, our growth could reach 20%.
One of Peng Shui's big ideas is to build a new city centre on this farmland a 20-minute drive away. In a couple of years' time, the billion-dollar project will be linked to the old districts via tunnel through the mountain. Investors are supposed to provide 23% of the cash, the bank 60%, with the balance coming from central, regional and local governments. Those facing relocation don't really care if this is a rash development or if it makes sound economic sense, so long as their payoff is worth it.
Us farmers can benefit from the development and construction, but if the government goes ahead with the project and we're worse off, who will agree?
The trouble is, as the People's Bank of China knows only too well, the real value of compensation risks being diluted by inflation, which despite 3 interest rate hikes over 4 months, accelerated in January to 4.9% year on year. The spur was a $4 trillion stimulus package, which cushioned China's export-reliant economy from the global financial crisis. In turn, this opened up the floodgates for huge levels of bank lending that saw the money supply grow more than 50% in 2 years.
It went to companies that bid up the price of land, bid up the price of natural resources around the world. When it did land in people's pockets, people put it into forms of tangible savings like real estate or even gold. And so what you've seen in China is actually asset inflation, not necessarily consumer inflation. But eventually, asset inflation is a tricky thing.
It's tricky because it feels like a boom. That is, until inflation spread to payrolls and the general basket of consumer prices, notably food. Even those with strong buying power, like this New York-listed chain with over 100 outlets, saw prices soar in late 2010.
Commodity price has gone up across the board. We've seen chicken prices gone up probably around 16% year over year. Rice, cooking oil, they all gone up. Pork, beef, almost everything.
And of course, property buyers are finding prices are still rising, defying measures like higher down payments and restrictions on multiple mortgages. As for the thousands of foreign companies operating in China, concerns are mixed, with much depending on which market they're selling to.
Some of these are targeting the fast-growing Chinese domestic consumer market. And even though we can see some declines now in consumer confidence index, I think their prospects or their concerns for the future is less than those who are here now for the sourcing and production for exports to Europe.
The government's primary focus, however, is the economic health of this nation. So today's leadership wants to move away from an export and investment-driven model to one powered by domestic consumption with single-digit GDP growth. This means allowing the renminbi to appreciate and also wean the economy off its addiction to cheap, ready available money. But this is easier said than done.
You're going to have a lot of people screaming for loosening again. And there are going to be a lot of entrenched interests, property developers, local government officials who want to meet their GDP targets, who are going to be screaming to resume the lending.
China's regions have already published their latest 5-year plans, and most have breakneck double-digit GDP growth targets fueled by investment. This could well heighten inflationary pressure, though local policymakers in Western China say inflation of up to 5% is beneficial.
It's good for the movement of capital, its viability. It's good for attracting personnel. It's good for restructuring, for adjusting industries.
Different tiers of officialdom have different priorities. And while China has an authoritarian government machinery, the leadership must perform a delicate balancing act with the regions where policy is often reinterpreted or sometimes phased in to fit with local needs. Over the coming quarter, the government's mettle will be tested.